to all. In today's session, we're all going to learn about the international budgeting and its techniques. So let's begin with the overview of the foreign investment. As what is all about the foreign investment is, foreign investment is an important or a significant part of every economy of a country. It includes the process through which the capital inflows from one country to another country, where the foreign investment is always been an important concept for the foreign investors who are going to get their ownership stakes in domestic companies. Foreign investment, in other words, we can talk about the foreign investment means the foreigners who are more interested to invest in the management part when they are more willing to invest in the companies. So this is a part of the you can say foreign investment in the foreign countries, where the investors or the foreign investors may get involved in doing the substantial investment or gaining an equity stake. So when they have a significant investment, definitely the foreign investors may also involve in preparing the business strategies. There are numerous countries across the globe who follow the process of globalization, and the foreign investment is always involved in the globalization process, which always aims to bring the nations together. It is an essential part of the globalization, and one of the major type of the foreign investment is the foreign direct investment. So through the foreign direct investment, multinational companies have investments in several countries around the world. In other words, it also refers the capital inflow from one country to another country, where the investors from one country to another countries invest their assets, invest their you can say the ownership stakes in their own businesses or in the other businesses or the projects, and of course they're more involved in doing up the financial investments in another country to generate more and more profits and revenue in the domestic countries as well. Let's take an example to understand the foreign investment, because it is also a significant part of the capital budgeting as well. Many companies set up the various manufacturing facilities in countries where the labor and the other costs are more affordable or cheaper. So an American company, for example, could sell its goods in the US, but he all get them made, to get all the goods to be prepared or to be manufactured in Vietnam. So you can see the opening manufacturing facilities in Vietnam, the companies is actually investing in the country, that is the US company. So the US company is more involved in investing or doing a foreign investments in the Vietnam, because the manufacturing companies facilities where the labor and the other costs are more cheaper in Vietnam. So that's why the US company is more involved in doing the foreign investments in such country. So the investments leads to the jobs and the paychecks in the, you can say in the Vietnam, where the more and more facilities, the manufacturing you can say facilities are to be more involved with the help of the US company, where they can spend more and more in the local economy as well as the taxes as well. So this is how the foreign investments may get involved from one country to another country, where all the facilities may get cheaper and it towards the more development of the country. Let's talk about the statistical facts. In the financial year 2024 to 25, the USA dollar in dollars provided approx $158 million in assistance to India. For the financial year in 2025 so far, the stance is about $38 million, which reflecting the adjustments in the US foreign and policy. So this is how the foreign investment is may get involved from one country to another country. So the World Bank approved a $1.48 billions loan in June 2024 to support India low carbon energy transition, including the green hydrogen and the renewable power. In December 2024, the World Bank extended $325 million loan to modernize the agriculture in Uttar Pradesh, which benefiting about 1 million farmers. In June 2025, you can say, according to the World Bank, they have sanctioned $426 million loan, you can say the Karnataka water security and the resilience program in you can say the renewable you can say takes and improve the Bangalore water infrastructure. So it's more about the renovation into lakes and improve the Bangalore water infrastructure. So this is how the statistical figures is always shows that in somehow and fully the foreign investment takes place from one country to another country. Now we can come up to the next section, that is the importance of foreign investments. So the capital inflow, it provides the additional capital which can be used for the country development or for the economic development and growth. The second one is a job creation, and after fueling up the growth and development, definitely the more and more jobs opportunities could be generated, and it ultimately leads to reducing the unemployment. Technological advancement, and these are often you can say associated with the introduction of the new technologies and the business practices. So the more and more advancement and the modernization in agriculture or in any sort of technologies, so definitely the foreign investments would get involved from one country to another country, let's say US to India, or you can say China to India, etc. Next one is the skill development. Foreign investors provides trainings to the local workers so that they more skilled about their you can say work, and in this way it develop the skills of the workers in some way. Next one is the access to international markets. So associating with the foreign investors and ultimately helps to the domestic firms so that they can expand more and more into the global markets, and which also ultimate help to increase the business activities or to increase the operational activities of the businesses. Next one is increased you can say exports. So it also increased the exports of the country, you can say who is an exporter country, and in this way it will help the country foreign exchange earnings as well. So the more and more exports would get involved, the more and more foreign currencies earnings would be possible. Now we can come up to the next topic, that is our next section, that is the types of foreign investment. The first one is foreign direct investment, second one is the foreign portfolio investment, third one is a foreign indirect investment, and the fourth one is sovereign wealth funds. So let's have a small overview of these types. So let's begin with the foreign direct investment. So what is all about the foreign direct investment is it is a situation when the foreign investors make a direct investment in a company or any sort of organization which is located in another foreign country. That is exactly the foreign direct investment. So this is a type of investment which is on long-term basis and involves the significant capital investments by the foreigners. It can take various forms like the acquisition of a foreign company, establishment of a new company or form a new company, or to purchase any real estate company, etc. So it could be done through various ways, which I already you can say shared verbally, and as well as is mentioned on the screen as well. So the foreign entity has a significant degree of control and ownership of their foreign investment. So this is how the direct investment could be done by the investors or the foreigners investors, or the foreigners or the foreign investor. They can directly make an investment in a company which is located in the foreign country. These are the examples of the FDI. The first one is Amazon, who have announced a $2 billion in foreign investment in India to expand its e-commerce operation and infrastructure. We can also take up another example of FDI, that is Apple. Apple is also ramped up its manufacturing units in India with you can say Foxconn and the Wilston. You can say investing in the iPhone production facilities in states like Tamil Nadu and Karnataka. There is also another example, that is Google, who is committed to invest $10 billion in India over 5 to 7 years under the Google for India digitalization funds to boost the digital infrastructure. In 2023, the Singapore-based GIC, that is General Insurance Companies, or you can talk about any of the, you can say the Brookfield Asset Management, you can say, which also made a substantial investments in India, which automatically relate to the renewable energy sector. And the last one is automobile sector. Automobile sector has also attracted the FDI, with Suzuki Motor Corporation investing further in electric vehicle, that is EV production facilities. So these are the various examples in respective years where the foreign companies have invested you can say in a company who are located into a foreign country, and that is exactly called the foreign direct investment. Next type is the foreign portfolio investment. So foreign portfolio investment is also a new type of investment in a foreign country, but basically the investment is to be done in the financial markets in the various sort of products like stock, bonds and other securities. Under this type, FPI does not involve any direct ownership or control over their investment. In fact, such investors have to buy and sell the securities in the open market with the hope that they can generate some profits from you can say from any of the changes in the market price. So if there is any other changes in the market price exist, then definitely these investors are more involved to buy and sell securities in the open market so that they can earn more and more profits. Next one is the foreign indirect investment. Foreign indirect investment refers the investments made through a third party or intermediary. So it could be a form in the form of mergers and acquisitions, or any of the foreign investors invest in the domestic company, which in turn invest in the another country located in the foreign country. So it also refers to a reinvestment process where the one company invests to their own company, and that domestic company invests to a company which is located in the foreign you can say country. So it is also one of the type of the foreign direct investments where the investments or the reinvestments takes place in domestic country, a domestic company, and then domestic company in another country will invest into another foreign country. So this is how the indirect investments could be done through the third party. Next one is sovereign wealth funds. This is also another type of you can say foreign investment, which are called as state-owned investment funds, which that are invest in the foreign countries. So these are typically funded by the foreign currency reserves, natural resources, revenues, and other source of income. So basically, it refers to the such foreign currencies you can say reserves which is mainly used for a significant investments in the infrastructure projects, real estate projects, or any other strategic assets in the foreign country. So when any company in one country invest to a company in another country, and through using up that wealth funds, especially in the infrastructure projects or the real estate or any other strategic assets, that actually called the sovereign wealth funds. Now we can come up to the next section of one of the most important, that is advantages of foreign investment. So these are the 5 main advantages, like employment opportunities, diversification of economy, access to international markets, a transfer of technology, and others factors, and the you can say stimulate the economic growth. So let's have an overview of these advantages. The first one is the stimulate economic growth. So foreign investment also stabilize the economic growth by investing, or you can say injecting the capital into the economy. So it's all about the capital inflow into an economy. So that capital can be used to finance the new projects. They can be used for the infrastructure projects or real estate projects, or expand the existing farms, or modernize the infrastructure, or you can say adapt a new technologies, or invent the new technologies which could create the jobs and of course increase the productivity. Next one is access to international market, and if foreign investment is also provide to access to the international markets, because it's all about the investment in one country to another country. So how the foreign investors would always keen interested to make a foreign investment in one country to another country, or to invest in the foreign country through their own investment process. So in this way, the domestic companies expand their customer base and increase their exports, and of course it also beneficial for the small and the medium sized enterprises. Next one is the transfer of technology and skills. So the foreign investments can also, you can say, ensure the new technologies, the expertise, professional teams, the skills which can be assist to the domestic economy, and of course in this way it also helps to improve their productivity, their competitiveness, you can say, when they bring the new technologies, expertise streams, or skills into the workers in a domestic you can say companies. So this also helps you can see in developing you can see the economies, and which the economies in where the lack of resources or the lack of knowledge which always been exist in order to develop a new technologies or products. Next one is employment opportunities. Foreign investment definitely can create the employment opportunities in the domestic economy when it comes to, or particularly in the labor incentive sectors, and in this way it could reduce the unemployment and the poverty conditions in the domestic economy or the domestic companies, and it also improved their standard of living as well for the laborers or the workers who are working in the companies in the foreign country. And the next is a diversification of economy. So the foreign investment definitely helps to diversify the domestic economy as well, in order to introduce the new industries or the products into the foreign market. And in this way, it could reduce the reliance on a single industry, or you can say export market, which can make the economy more, you can say, reliant on external shocks. So it could be a recession, it could be an inflation, it could be a chances of, you can say, more recession, which could lead to a more unemployment and poverty situations. Next is issues with foreign investment. The first one is dependency. So the over reliance on such investment, definitely it makes the country dependent on the foreign capital. So in return, it could result to an underdevelopment, or you can say, of its own capacity as well. Next one is the fear of external shock. So such investments being dependent on external economic factors, which could mean to receive the economy becomes more and more vulnerable to the external economic, you can say, shocks. Next one is the profit, you can say, margin. So the profits made by the foreign investors can also be repatriated, which ultimately leads to a capital outflow more and more from the investment receiving countries. Regulatory challenges. In order to manage the, you can say, all ill sides of such investments, which definitely requires strict regulations in case of in case of making an investment in the foreign countries. Next one is policy uncertainty. Inconsistent, unpredictable policies environment definitely decrease the investment opportunities in the foreign countries. Next one is the labor exploitation. So it also has a potential, more potential to exploit the local laborers if they are not being properly regulated in their work. Next one is benefits of FDI. So there are two countries for the host countries and the home country. So when we talk about the host countries, what are the benefits of FDI? The first one is FDI creates jobs, and of course the increase the economic growth through the capital invested, and it automatically generate the job opportunities, and easily modern technologies can be transferred from one country to another country in the form of companies, or to form a new companies. Next one is FDI contributes to infrastructure development through the investments in terms of transportation, electricity, telecommunication, etc. And it also come up to some projects which ultimately helpful for the development of the economy, but somehow it may also cause the environmental issues as well. Host countries lose some policy autonomy. In this way, when we talk about the foreign direct investments, then the host companies might lose some policy autonomy, a freedom, or a control, as they have to conform the demands of the foreign investors. And in this way, the foreign direct investment can introduce to apply the best practices in corporate governance and the management for the growth of their own companies. Next one is FDI gives access to international markets, and of course the supply chain, which helps the local firm, but it also exposes to the global competition as well. FDI also creates more jobs directly through the operations of the foreign associations or the collaborations, or indirectly through the higher demand of their goods and services from the local suppliers. And ultimately, it reduces the unemployment and poverty at some extent. FDI also gives an access to the foreign markets for the local companies as well, and it also becomes an important part or a significant impact of the global supply chain. And in this way it could expand the more and more customer base and the sales margins. Next one is the technology transfer. Technology transfer requirements, performance benchmarks or matrices has also been imposed on the foreign investors to maximize the technology spills overs and the beneficial impacts. Let's talk about the benefits of FDI for home countries. Companies who gain the higher profits and returns from their FDI projects, so they get more and more returns from the FDI project, and in this way the profits it's repatriated, you can say back home, escape the host country taxes. So automatically they don't need to, they just take back that profits into their home country, and accordingly to avoid the country taxes, resulting in the loss of potential tax revenues in the host countries. FDI provides an access to a cheaper resources and the lower cost production location, and of course it'll open up a new markets for the further growth, and it also exposes the firms that about the various types of risks that exist in the foreign markets. FDI it also enables the international expansion and operating of skilled technologies, and it could result you can see into a job losses as well at home countries, especially where specifically when we take up a situation about the labor incentive sectors. So there could be a risk of the strategic technology and the intellectual properties outflows to host countries through FDI. Multinational companies could gain a high profits from utilizing the advantages like the intellectual properties, brand recognition in the foreign markets as well. It also allows the firms to increase the production or sales in order to you can say spread or entered into a large global customer base and achieve the economies of scale, where the more and more productivity you can say a situation which always been exist in the global markets. Next one is it access to natural resources and the lower cost location, which always enhance the global competition you can say in the home countries companies as well. FDI forces the domestic firms to improve efficiency through competitive pressure. So when there is a competitive pressure is always been involved, then definitely FDI is always insist the domestic firms to improve their efficiency so that they can also you can sustain into a competitive environment. Now we can talk about the most important part, and what are the factors which affect the FDI. It could be a political stability, wage rates, tax rates, transport and infrastructure, size of local market, commodities, and the access to free trade area. So these are the factors which affect the FDI either positively and negatively. The first one is wage rate. So a major incentive that to be given to the laborers or the workers is the wage rate, and it is also important for the multinational companies to invest abroad is to outsource the labor intensive production to countries with lower wages. So if let's take an example, if the average wages in the US are $15 an hour but $1 an hour in the Indian subcontinent, then definitely US is more willing to invest in the Indian subcontinent. Why? Because in order to reduce the cost by outsourcing the production. So this is how the Western firms have invested more in the clothing factories in the Indian subcontinents. Next one is the labor skills. Some industries may require the higher skilled labor. For example, the pharmaceuticals and the electronics sectors, and the multinational companies are more involved to invest in these sectors which are associated with the countries, or where the combination of low wages are always been involved, which ultimately leads to a higher productivity and skills. Next one is tax rates. Large multinationals such as Apple, Google and Microsoft, of course, they are more interested to invest in countries where the lower corporation tax rates are always exist. Let's take an example. Ireland has been a successful in attracting the investment from Google and Microsoft, because it has been a controversial, because Google has tried to try to increase all profits through Ireland, despite having operations in all European countries. Next one is transportation and infrastructure. So one of the key factor in the desirability of investment are the transport cost and the level of infrastructure. So a country who are having a lower labor cost but if there is the high transportation cost to get the goods into a world market, which is actually a drawback for the countries, or for the various countries too. So the countries with access to a sea, or which could be an advantage to a landlocked countries who will have a higher cost to ship goods. So this is also one of the factor which influence the transportation and the infrastructure facilities, because ultimately if the cost would be higher to ship the goods and entered into a world markets, then definitely it could be a disadvantage for the Western firms or for the foreign investors to do in investments in transportations and the infrastructures. Next one is political stability and property rights. So foreign direct investment has an element of some sort of risk in terms of political risk or the economic risk, etc. So the countries with an uncertain political situations, definitely it's a major drawback, it's a major concern for the Western firms or the entities. Let's take an example. The recent Russian economic crisis combined with economic sessions will be a major factor to discourage the foreign investment. So whatever the economic sanctions has been imposed, which definitely a leading factor to discourage foreign investment by the foreign countries. Next one is the size of economy and the potential for growth. So the foreign direct investment is targeted to sell the goods directly to the countries which involved in attracting the investments. So for example, Eastern European countries with a large population, for example Poland, offers scope for the new markets, and they may also attract the foreign tourists to invest more on our firms like Volkswagen, which always built to invest and build up the factories in Poland to sell it in the growing customer class. Next one is commodities. So one of the reason of foreign investment is the existence of commodities, and FDI, and the growth of the FDI has always been involved, or one of the reason is the commodities within the Africa, or the Chinese firms who always looking for a secure supply of commodities. Next one is exchange rate. So a weak exchange rate in the host country may attract more FDI because it will be cheaper for the multinational companies to purchase assets. So a weak exchange rate will, which always offers the more and more investment opportunities, you can say, by the host countries to purchase more and more assets of a home country. So next one is the clustering effects. So the foreign firms is always attracted to invest in the, you can say, similar areas to where the existing FDI is always be sustained. So the reason for doing this is the benefit of economies of scale, where the growth of the service sector or the transportation sectors is always collaborate or together to make a comfort and to increase the productivity. So there will be a greater confidence to invest in such areas with a good track record. And the last one is access to free trade areas. So a significant factor for all those foreign investors or the Western firms to invest in Europe so that they can easily access to the European Union. So a single market, which is a free trade area, but is also a very low non-tariff barriers because of the harmonization of rules, regulations, and it could be a free movement of people where the tax is very low, whereas you can say the tariff barriers is also you can say very low. For example, UK post BR exist is likely to be less attractive to the FDI if it is outside the single market. So if UK is outside the single market, then the FDI would be a less attractive spot in UK. Next is, what is exactly the international capital market? International capital budgeting. So the international capital budgeting, it refers a process where the global firms use to evaluate and select the long-term investment project in foreign countries, and this is one of the process where the foreign companies which immediately look the expertise team to evaluate, to assess that which investment project could be more profitable in the long term basis. So when the firms operate in the multiple nations, it faces an additional you can say hurdles, or you can say issues, and of course that could be linked to a domestic capital budgeting. Multinational companies or the multinationals must access the projects in other currencies, and of course they also consider the nation specific risks like political, currency, regulatory risk, because these three main type of risks which always exist in the international capital budgeting. So they use the same strategies or the same matrices like the net present value, internal rate of return, payback period, and they accordingly adjust the discount rates and into their account for higher risk in some nations like Germany, you can say Italy, etc. So the governments may provide the you can say the more and more benefits like the tax breaks or the subsidies that impact the projected profitability of profits in a positive manner. Now, these are the factors in international capital budgeting. So, the exchange rate risk or the currency fluctuation, political and the regulatory environment, country specific, you can say risk, cost of capital or the discount rates, regulation of profits and the tax implication, and the cultural and the marriageable challenges. So these are the 6 main factors to consider in international capital budgeting or before selecting an appropriate long-term long-term profits. The next one is the first factor is the exchange rate risk and the currency fluctuation. So when while assessing any capital budgeting decisions in an international market, organization must research that what would be the factors which are need to be considered to assess the exchange rate risk or the currency risk. So the currency fluctuation is always been you can say differs and automatically impact significantly upon the profits of the foreign investments. Let's take an example to understand. Suppose a US based multinational companies invest in a Chinese subsidiary to produce the electronic components. So the investment is definitely denominated in the US dollars and the subsidiaries companies generate the revenues in the Chinese yuan in its currency. So if the yuan depreciates against the dollar, then the multinational company's profits may decline due to the unfavorable exchange rate movements or due to the exchange rate risk. So it could depreciate, you can say at any time, it could appreciate at any time, and that's why the currency fluctuation would definitely impact the profitabilities of the foreign investments projects in a long-term basis. Next one is the political and the regulatory environment. So the political stability and the regulatory framework of the host country is significantly impact the capital budgeting decisions, because these are the factors which ultimately impact the capital budgeting decisions, or if any unforeseen changes in the government policies, in the taxation policies, or any of the you can say tariff or the non-tariff trade agreements, then definitely impact their business operation and affects the investment returns. So let's take an example to understand this factor as well. An Indian pharmaceutical company plans to acquire a European drug manufacturer, and before proceeding it must research the European Union regulatory environment, their patent laws, their potential policy shifts, because it is very important to proceed or to associate or collaborate with the foreign country manufacturer. Then it is important to research on these factors. So any of the sudden change in the, you can see the pricing, drug pricing negotiation, it could affect the project profitability as well. So it is very important to consider all those factors which impact the project profitability. It is important to research on these factors before taking any impactful or meaningful decisions for the projects. Next one is country specific risk. So each country present the unique risks related to the economic conditions, their legal systems, their cultural norms, their infrastructure, and these risks is always influence the investment patterns or their feasibility and requires a through a proper analysis. Let's take an example to understand this point as well. A Brazilian energy company evaluates an hydropower project in Peru. So it must consider the factors like the water availability, environmental regulations, local community support, and if any of the factors failed, then definitely it would leads to a country specific risk, and it would harm the project profitability or the project delays or any of the you can say cost overruns you can say period to period. Next one is, or the next factor is the cost of you can say capital and the discount rate. So discounting is one of the appropriate you can say factor to find out that what sort of discount rate is to be imposed to the international projects, which is a very crucial decision. So the cost of capital, it differs across the countries, and which also due to the differences in the interest rate, inflation, or any other factors which also fluctuates both discount rate as well at the cost of capital too. Let's take an example. A German automaker plans to expand the production facility in Mexico, and the company must adjust its discount rate to reflect the Mexico specific risk profile. So in this way, when you want to expand any facility in another country, and the company always needs to adjust its discount rate so that Mexico risk profile could easily reflect. So it failing to do so, it leads to an incorrect project valuation. The next factor is the its repatriation of profits and the tax implication. So the multinational firms must consider that how they will repatriate profits earned abroad. It would be tax treaties, withholding taxes, transfer pricing, regulation is always you can say impact the outflow or inflow of funds back to the home country. So let's take an example. A Japanese electronic conglomerate invest in a joint venture in South Korea. It must navigate the South Korea tax laws and ensure that efficient profit reputation is to be come up to the Japan. So this is how research is to be done in order to understand what would be the tax laws, and efficient profits would be generated and immediately come up to the Japan. Next one is cultural and the marriageable challenges. So the international ventures involve cross-culture interaction and the management complexity. So whatever the difference exists in communication style, decision-making process, definitely will affect the project execution. Let's take an example. A French luxury fashion brand opens a retail store in China. Effective communication between French headquarters and the Chinese stores manager is essential to maintain a brand consistency and the customer experience. So the language is also important for to consider the main profits generation and to experience the customers in a positive manner. Next is methods and techniques of international capital budgeting. The first one is the payback period method. It refers to a time taken, that how much time has been taken by a proposed project so that they can generate more and more income to cover up that initial investment that they have made on such projects. So the project with a quicker payback period is mostly chosen by the company. But how to calculate the payback period? It's equal to the initial cash investment by annual cash flow. So let's take an example to understand how to calculate the payback period. So this is in a small example which has been considered. An enterprise plans to invest $1 lakh to enhance its manufacturing process. So $1 lakh is an initial investment has been done by the enterprise on its manufacturing process. Next, it has a two mutually independent option in front, product A and product B. Product A exhibits a contribution of $25 and product B is a contribution of $15. The expansion plan is it's projected to increase the output, that is the units, by 500 units for product A and the 1000 units of product B. We need to estimate, as we need the initial cash flow which to be used in calculating the payback period. So the first step is to calculate the incremental cash flows. So as what would be the contribution? Here it's 25 into 500. Here we need to calculate the contribution per unit which has been given by for the product E and product B. So 25 into 500, that is the you can say the incremental cash flows where the contribution of both the products into their output. So contribution into output, we can easily calculate the incremental cash flow. So for product A, $25 is contribution and output is 500 units. To 25 into 500, the initial cash flow is 12,500 for product A, and for the product B, $15 is a contribution and output of a product B is 1000. To 15 into 1000, it becomes the 15,000 for product B. So as we have estimated the incremental cash flow which will be used in calculating the payback period. So the next task is, our initial cash investment is already given, that is $1 lakh. If you read up the question properly or carefully, it is mentioned the enterprise plan to invest, though the initial investment is $1 lakh. And the incremental cash flow which has been estimated here for the product A, that is 12,500. So as it is given, the payback period will be 8. So product A, the initial cash outflow is $1 lakh and the initial cash flow is $12,500. So the payback period is 8 years for product B. And the same process has been applied for the product B as well for calculating the payback period for the same. So the initial cash investment for the product B is $1 lakh and incremental cash flow is $15,000, and the payback period we can easily calculate the 6.7 years. Now out of these two, which product the company choose? So this brings that the enterprise to conclude that product B has a shorter payback period and product B will be chosen by the enterprise. So the more the payback period you can say shorter, that the company will choose that particular product. So if any product having a you can say less payback period, the company will choose that product only. Next concept is adjusted present value. Next method is a adjusted present value, which separates the firm operational value from its financing, and ultimately it requires a two-step process that how it will calculate the firm all equity value and then add and subtract the financial impacts like tax shield or debt cost as well. So once we need to calculate the you can say equity value, and then immediately we add or subtract what could be the factors, financial factors like tax rates, debt cost, etc. And this is how we can easily calculate the adjusted present value, because the present value of cash and cash flows is already given, but how you adjust that present value using the various financial factors like tax shield or debt cost, which is also equally important to understand. So the adjusted present value is best for the scenarios with shifting the capital structures like leveraged you can say buyout or any major restructurings. So by isolating the effects of financing, the APV enables the one of the most important method to evaluate the firms with their debt arrangements or any those operating expenses across the multiple taxes jurisdiction. So APV is a project or a company net present value if financed solely by the enterprises plus the net present value of financial benefits like tax shield, any debt cost or any other incentives which has been provided by the enterprise. It also helps the business more smarter decision how much the debt is to be considered. They can be clearly explained the level of the borrowing which ultimately affect the company value. So for the investors, it gives a fuller picture of what the company worth. They can easily understand how well the business is doing, how its financial choices also affects its value. So when we talk about the big financial matters such as when one company buy another company, so it also helps everyone in order to understand what would be the value being exchanged between the companies when there is an agreement follows or any changes exist, at how much the debt the companies has, which the one company has bought the another company. So these are the factors it also being studied before making any a big deal in terms of financial matters. How to calculate the adjusted present value? So this is a formula which has been mentioned on the screen. The adjusted present value is equal to the unleveraged firm value plus net effects of debt. Now what was the net effect of debt? Net effect of debt includes tax benefits created when an interest on the company debt has been a tax deductible. The benefit is easily calculated as an interest expense times the tax rate only applies to 1 year of interest and tax. So the present value of any cash flows, it would be the you can say interest tax shield. And how to calculate the interest tax shield is equal to the tax rate into debt land into interest rate by interest rate. So this is a formula that how you calculate the adjusted present value, which is equal to the unleveraged firm value plus net effects of debt, which could occur. It includes the interest, it includes the tax rates, but how to calculate the tax shield, interest tax shield, that to be formula has been mentioned, tax rate plus debt land and into interest rate by interest rate. So let's have a question to understand. Let's interpret it, follow the example. The net present value of the unleveraged firm is where the unleveraged firm is where the no tax follows, where no tax deduction, no tax deductible regulation has been followed. So the net present value of such firm, it's $2 lakh. Present value, and is also called the present value of the unleveraged cash flows obtained by discounting the you can say forecasted free cash flows forecasted based on the unleveraged cost of equity. FCF is a free cash flows which is based on the unleveraged cost of equity. The applicable tax rate is 35%. The debt level is $70,000 and the interest rate is 5%. Now we need to calculate the adjusted value of the project. So these are the solution. The present value of unleveraged firm is $2 lakh is given. Tax rate is given 35%. Debt is also given $70,000. Interest rate is also given 5%. Now we need interest rate is given, tax rate is given, debt is given. Now we need to calculate first you can say interest tax shield, because this amount will be used under the net effect of debt, which includes the tax rate, which includes the debt also. So in order to include both, we need to calculate first interest tax shield. So this is a formula, debt load into interest rate into tax rate by interest rate. So 70,000 is a debt load into 5% is interest rate into 35% interest rate by interest rate 5%. So the while calculating and segregating the amounts together, we will get the indirect tax interest tax shield, that is $25,500, and in this way the average adjusted present value, which is equal to the unleveraged firm value plus net effect of debt, and the values is already estimated $2 lakh plus $24,500, and when we add these two values together, we will get $2,24,500, and this is called adjusted present value, and it is one of the most important method of the international capital budgeting as well. That's it for today. Thank you so much for listening this lecture. I will come up with the more and more relevant and important topics in the upcoming session. So till time, thank you and namaste to all.